So we'll begin with Rama Nyang from CGTN Africa. So Rama is asking, given how weak domestic consumer demand is, does CBK expect that the CBR and CRR cuts, that's the central bank rates and the cash reserve ratio cuts, will be sufficient to revive credit growth without matching tax cuts? George Obulutsa from Reuters News. So just a second.
How do I get?
Good. So we'll start again, just making sure the governor has the same set of questions in front of him. So Rama Nyang from CGTN Africa. Given how weak domestic consumer demand is, does the Central Bank of Kenya expect that the central bank rate and the cash reserve ratio cuts will be sufficient to revive credit growth without matching tax cuts? George Obulutsa from Reuters News is asking, what extent do you see the U.S. freeze on foreign aid affecting dollar inflows to Kenya and by extension the foreign exchange reserves and the exchange rates? From this batch, the final one is from Julian Zamboko from NTV Kenya. 2025 is the first year for increase in core capital to 3 billion shillings. Any update on the 13 banks with a core capital below 3 billion shillings?
Okay, let me start with Mr. Rama Nyang. Yes, we do expect the reduction in the CBR and the CRR to impact the reduction in lending rates by commercial banks. I think, as I've said earlier, the banks have not responded as quickly as they should have. But I do believe that since August, when we started to lower the CBR rate, we have now lowered the CBR rate by 175 basis points, and then including the 50 basis points from yesterday, that's 225 basis points. At the same time, the TBO rates have, as I indicated earlier, some have declined by actually between 600 and 700 basis points. Yeah, and I know one of the banks have given the explanation that they are having to offer high deposit rates so as to be competitive with their depositors who can access the treasury bills. But I think by now there must have been deposits that are maturing since we started to lower the CBR and since the T-bills started to come down. And if we just follow the risk-based credit pricing model, there is no reason why the lending rates to the private sector should not come down. And that's why we are saying let's do some on-site inspection of the banks just to make sure and make sure that indeed the banks are following up on this on the banking sector charter that we agreed upon, and if it's true that their cost of mobilizing funds has not changed, well and good. But if it has, that reduction in cost of mobilizing deposits should be passed on to consumers and to borrowers, and should not be used to pad the profits of the commercial banks. So yes, I do believe that given what we have agreed in terms of the risk-based credit pricing, that the actions that we have taken to date should reduce the interest rates that banks are charging. I think once that happens, we should be able to see more demand either for consumer durables, but also for investments. And that increase in aggregate demand is what we are expecting would also stimulate economic growth, and for that reason we have increased the growth from 4.6% in 2024 to 5.4%. Obviously, if there are tax cuts, that raises, of course, that will increase disposable income, but that also raises other issues with regard to the sustainability of the fiscal position, whether that increases the fiscal deficit, and how that will take us towards a sustainable debt position over the medium term. There's a question from George on the U.S. freeze on foreign aid affecting dollar inflows to Kenya, and by extension the foreign exchange reserves and the exchange rate. We don't see much impact on the exchange rate from the freeze on aid. As I said, the reasons I've given for the strengthening of the exchange rate are mainly current account developments, and in particular remittances, which has been very strong. What could affect the exchange rate perhaps is if there is a significant reduction in remittances from the U.S., which we don't see that happening, or maybe at a very large increase in oil prices, which would increase our oil import bill, which also we don't see. So really, going forward, we do see our level of reserves remaining fairly strong, and we also do see the exchange rate remaining stable. Julian's Amboko, you raised a question about the increase in core capital. Any updates on the 13 banks with core capital below the 3 billion?